In this video, I'm going to explain the difference in unearned revenues and deferred inflows in governmental funds. So let's take a look. In this governmental funds example, this is a city. We see that there's a general fund and the American Rescue Plan. Now this is COVID money, and we can see in this ARPA fund, it has cash of $654,000. Notice in the liability section, there is unearned revenues, and we see the number 556,856. So these are monies that have been received, but it's grant money that's been received, but the eligibility requirements have not been met. So the city has the cash, but they haven't earned the money. That's why we call it unearned revenues. If the city never complied with the grant agreement, it would have an obligation to return the money. And that's why this is sitting inside of liabilities. Now notice just below here we have deferred inflows of revenues. And then it says unavailable revenue property taxes, and there's $50,278. We also see, now we're looking obviously in the general fund now, but there's a receivable here for taxes of $136. So what is this amount? Well, this is the amount of property tax revenues that have not been collected within 60 days of the year end. So if we go from September 30 and we go 60 days out, if the city hasn't collected some of these property taxes, then that portion shows up as unavailable revenue. Remember, in governmental funds, we're looking at whether or not the monies are measurable and whether or not they are available. Because these funds haven't been collected within the 60-day window, we say they're not available. They're not available to pay current expenses. And so we see the phrase here, unavailable revenues, property taxes, and notice it's in the deferred inflows. Now, I don't know about you, but sometimes I get a little confused about, okay, what's the difference in unearned revenues and then this deferred inflow amount? Why do we have these two different categories? It almost feels like the same. And before we had GASB 63 and 65, those amounts showed up basically in deferred revenues. But after 63 and 65 came out, which was I think in 2012, now we've got this new category called deferred inflows. We also have deferred outflows, but in this video we're talking about deferred inflows. So why did GASB add this extra category? Well, the reason is there's a difference in what is a liability and what is a deferred inflow. And the difference is, for liabilities, there's an obligation to pay. So if we go back to the unearned grant money, if they don't meet those eligibility requirements, we're going to have to return. There's an obligation to pay or return that money. So that's why the grant money is showing up as unearned revenue. But this property tax money, in effect, it's been earned. It's just not available. So that's why we say unavailable revenues here. Now notice we do not use the phrase deferred revenue here. And you're precluded from using that language for unearned revenue. So you'd need to call it, just as you see it here, unearned revenue. And down here you'll have unavailable revenues. Now, let me explain a little bit more about these differences here. So we said there's an obligation to pay for liabilities. There's not an obligation to pay for deferred inflows. Think of deferred inflows as parked revenue that will be recognized in a future period. So that revenue hasn't been earned. It's not on the statement of revenues, expenditures, and changes in fund balance. it's being placed here until it becomes available, then this amount would be recognized as revenue. So we're parking this amount in deferred inflows until it is available, and then the revenue is recognized in a future period. So I'm repeating myself as I say what I'm about to say on purpose. Up here we have an obligation to pay. Down here we do not. Down here we just have amounts that will be recognized as revenue in a future period. Now let's go take a look at the statement of net position and see what we see there for these items. As we look at the statement of net position, of course this is your government-wide presentation, and so for this statement we took the general fund and all the other governmental funds and we brought them together. Then we have that reconciling information that brings us up to the government-wide level, and then we have governmental activities here. So that American Rescue Plan, it's embedded in here. Now this is a full accrual statement here. It's not modified like it is down at the fund level. So that 60-day rule is no longer in play at the government-wide level. But what is in play is this idea that we have a grant where the city has not met the eligibility requirements, and because it hasn't, it has not earned that revenue. So we still have unearned revenue, and we see that amount appearing here. Now, as we drop below the liabilities, notice there's no deferred inflow section. What happened? Because if we go back to the governmental fund level, we'll do that just for a second. So here we are back at the governmental funds. Remember, we've got liabilities here and we have deferred inflows here, but not so at the government-wide level. Here we are back at the statement of net position, governmental funds. Here's the liabilities, and there's no deferred inflow. So why is that? Well, I go back to what I said just a minute ago. For the governmental activities, we're full accrual. We're not using that 60-day rule anymore. And so that revenue is recognized at the government-wide level. It's not recognized at the governmental fund level, but it is at the government-wide level. So that deferred inflow goes away, but the unearned revenue does not. So either way, whether it's full accrual or modified accrual, we still have unearned revenue because there's an obligation to return these funds if the city doesn't meet the grant requirements. In summary, I just want to say, the difference in unearned revenues and deferred inflows is whether or not there's an obligation to pay. If there's an obligation to pay, such as grant monies where the city hasn't met the eligibility requirements, then it's a liability. If there's no obligation to pay, then it's going to be in deferred inflows when that money is not available. So if we have property tax monies, we collect 60 days from the end of the year, those revenues get recognized, but the monies collected after the 60-day time frame go into the deferred inflow bucket, and they sit there until they become available in the next period, and then they'll become revenues. Hope that helps. I'll see you in the next video. Bye now.